step in valuation is gather the information about yourself, gather the information about the company, about the business. So key focus is estimating the stream of future benefits from the business. So if you estimate very high benefits, the valuation will be very high, of course, correct? If you estimate lower, the valuation will also be lower, right? So what is the, when it is beneficial to project high future benefits or project low benefits? High benefit, right? So when you are making a 5-year plan, what do you want to do? You want to go as high as possible, correct? But you don't, but can you just go as high as possible only on paper, or you need to prove it by way of some business plan? So you need to be established with that cash flow or the future benefits that you are generating from the business today. Is it achievable or not? And how you are going to achieve it? Correct? In the previous class we said you may need to invest more, you may need to jam up the capacity of your business, you may need to hire more people, you may need to do a bit of more market research or market penetration expenses, right? So if you are able to clear up that and establish that the market exists after 5 years, which you can penetrate now and get the maximum, your value will be maximum as well. Okay. Most of the startups, when they are able to raise millions of dollars, forget about hundreds of thousands, 200 million, 300 million dollar for $1 billion valuation, that's how they do it. They project, they tell that okay, in the future year this is gonna be the benefit, the ultimate benefit. Okay, so you need to aim the highest, and then you will be able to get maybe the middle. But if you don't aim the higher, you will not be able to get it, correct? And estimate the risk associated with achieving these benefits. What do you need to reach there? You need peoples, you need money, you need marketing, you need technical, you need development. What exactly you need, and what are the possible chances that you will be able to reach that asset? And you need to show some kind of timelines, right, in your business plan. Value is always benefit divided by the risk. The value is equals to benefit divided by the risk. The risk is required rate of return. The higher the risk, higher required rate of return. Higher the value, higher the future benefits, higher will be the value as well. Correct? That's a simple formula for calculating the value. What is the benefit? At what rate it's come from? Clear? Okay. So for that, you need to analyze the information of your existing business. So we learned already common size analysis, comparative analysis, trends. Apart from that, we also need to analyze non-financial information like the management. What is the competency of management? What are their skills? Have they been successful in the past? It is established fact. If you are founder of one company which is successful, you exit and start a new company, your valuation automatically is very high, because you have a history of being successful. Okay, so maybe not on your first startup, maybe in your next startup you will get a high valuation automatically, because you have a history of being successful. And if in your team you have somebody who has been successful, so it's always wise to have other founders or co-founders who were successful in the previous ventures. So you may need to highlight what they have achieved in their previous work or in their previous assignments. Not necessarily in startups, but in the other businesses as well. Okay, what are the competition? So you know about the SWOT analysis already, right? Strength, weakness, opportunity, threat compared to your competition. So what are your strengths and weaknesses compared to your competitor? What are your opportunity and threat compared to your competitor? The better planning you are able to do it, the investors will feel more comfortable that you know who are your competitor, you know who is the market, you know what are the weaknesses, and if you are able to fix it, you will get a higher valuation. If you don't know about it, bye bye. Right? Products and quality. It also depends on your product, your quality, how viable they are. This is a very subjective matter. It depends on how the investor looks at it. and how well you are able to carry it out. For example, the WeWork, right? Now, have you seen the latest interview by SoftBank bank chairman? That he said that the WeWork chairman, the WeWork founder, Adam, he was so impressive that he was swayed away by his manner or by his growth plans, that he didn't look at the fundamentals of WeWork. Okay, so that was different. Then the customer and supplier concentration. If your suppliers, if your customers are limited and your suppliers are limited, your business tend to be more risky. Correct? So if you can demonstrate your suppliers are widespread, or you can demonstrate multiple use cases of your business, that's what I was saying in the previous class. If you can develop more use cases, the more use case means the more diverse your customer will be, the higher value you will be able to get. Because it's a very simple fact, the investors want to know what is the optional, what are the options. If tomorrow something go wrong with this particular market segment, will you be able to survive with another use case or not? Correct? So if your customer base increase, potential customer base increase, the higher value your startup will be. Okay? And the suppliers as well. So you don't want to depend on one supplier all the time. You may need to develop more diverse supply chain. Okay? Fact.
Most of them are like more tangible. I mean,
Yes, none of them, non-financial analysis, all intangible things. Yes.
This is all quantitative.
Yes, all qualitative.
Qualitative.
The quantitative is only the financial analysis, your common size, your comparative analysis, your trend analysis, that's it. The qualitative aspects actually make for startups especially, because you don't have a lot of financial analysis, right? Maybe you are working only 1 year, 2 years, and you are still not making any profits. You are just starting up. So you may not have a lot of quantitative analysis to prove your value, but you need to have more qualitative aspects of your value, which is more important in the initial phase.
So it doesn't say that there is a weight between the.
There is.
There is a weight.
There is a weight. We will see in the future slides. There is a weight between these aspects. What is the most favorable one? Okay. So factor which influence the investor decision is hotness of the industry. Everybody want to ride on the hotness. If it's hot happening, they want to invest more, right? If the industry is new fairly and nobody is really looking at it, they are also not interested. Okay, pre-money valuation revenues. If your startup is already making money and before you raise the funding, you will have much higher value. There are a lot of now LinkedIn series. If you are not yet subscribed, I would suggest you go to the LinkedIn. There are few investors who are doing the investing series. They give ideas to the startup, and one of the idea there is, if your startup can show you are generating money without raising any capital, you will get much higher value. He also go on until saying that you should not raise money when you need it. Actually, you should raise money when investor want to invest your money, because you will have a greater bargaining power when investors want to invest money in your business rather than you need the money from them. Okay.
Why the investors don't just starting up a founding team and started with this idea? Why the investor let the
So many reasons.
Yeah.
Because
you mean that this is investor idea, right?
Yes.
Investor ideas.
Investor is giving ideas to the founders. Basically, he is teaching.
One to.
He is because that particular investor that I am talking about is frustrated with the founders, because he keep on posting on his LinkedIn that founders come and tell him that the investor not investing money. They always ask for so many questions. So he is now going back onto the founders and say founders need to be reasonable when asking money.
That's one of the things that we're trying to do in Pandia as well. We'll have more ideas, give them more ideas and classes about what they should prepare.
What you should prepare before you go to the investor.
Yeah, that's the idea.
Yeah, so he is actually teaching the founders how to approach the investors. So you don't approach the investors just by sending an email or sending a stupid presentation only, right? You need to have a proper profile of yourself. You need to have a proper following. You may need to have a good pitch when you want to propose to the investors. So investors actually look at that, how well you are able to sell. If you are not able to sell yourself, how will you sell the product, right? So that is a very important aspect in valuation, especially for startups. These, because the financial matters are not really important, the qualitative matters are highly important for startups. And reputation of your team, the traction, how much customer you have been able to get, how much customers you have been able to retain, and is that the customers are keep coming to you again and again and again or not one time use. So that's why the companies nowadays normally focus on trying to develop multiple tractions within the same customers. Try to get lifetime value of the customer, and what kind of distribution channel you are using for marketing your products. So these are the things which in fact investor decision on investing or not, and how much value should they should give. Okay, so now we are coming to estimating the value.